Okay, we're back in Chapter 10, ACC 120 Financial Accounting, and now we're looking at Learning Objective 2, which covers the recording of the issuance of common stock. Now we have a bunch of different terms for stock. Authorized stock is all of these different ones. Between these, you're going to have issued stock and unissued stock. Within issued stock, you'll have outstanding stock and treasury stock. Let's look at these different types of common stock. Authorized stock are shares that are available to sell. They are made up of issued and unissued stock. Issued stock are shares that are actually sold. These are made up of outstanding and treasury stock. Outstanding stock is share issued and held by investors. Treasury stock are shares that were issued, but they were then repurchased by the company. Let's talk about par value. A lot of these terms that we're going to see throughout this chapter are going to be the kind of things that you're going to be very interested in if you are looking into becoming a financial advisor. Passing some of the exams are going to involve many of these terms. So, legal capital per share of stock that's assigned when the corporation is first established is the par value. Now, par value has no relationship to the market value of common stock. Some students might confuse par value with the market value. Par value is just the legal capital per share that is set when the corporation is first established and actually is unrelated to the value. The market value per share is equal to the current share price. In most cases, the market value per share will far exceed the par value. Let's look at some accounting for common stock. Assume that Canadian Falcon issues 1,000 shares of no par common stock at $30 per share. When they issue this with the no par, they're just going to debit cash for the increase in cash for 1,000 shares at $30 a share, so debiting cash for $30,000. And they're going to credit common stock for the same amount, the $30,000. This is what it looks like when you issue no par value common stock. Now let's look at par value. Assume that Canadian Falcon issues 1,000 shares of 1 penny par value common stock at $30 per share. It's going to look a little different. You're still going to debit cash for the amount that you sold it at. So 1,000 shares at $30 per share. Now your common stock, though, you're going to recognize that at the par value. So you're going to multiply 1,000 shares times a penny. So you're going to be crediting common stock for $10. The remainder is going to go into your additional paid-in capital. This is what it looks like when you issue common stock above par value. Both common stock and additional paid-in capital are stockholders' equity accounts. If no par value stock is issued, the corporation debits cash and credits common stock. If par value or stated value stock is issued, the corporation debits cash and credits two equity accounts, common stock at the par value or the stated value per share, and additional paid-in capital for the portion above par or stated value. Let's do a quick concept check. Company A issues 20,000 shares of $5 par common stock at $12.50 per share. The entry to record the issuance would include which of the following: a debit to cash of $100,000, a credit to common stock of $250,000, a credit to additional paid-in capital of $150,000, or a credit to additional paid-in capital of $250,000. If you chose a credit to additional paid-in capital of $150,000, you are correct. The company debits cash for the amount received. So that's $250,000. We got that by taking the 20,000 shares times $12.50. You're going to credit common stock for the par value. So that is $100,000. The 20,000 shares times the par value of $5 per share. And then you're going to credit additional paid-in capital for the difference of $150,000.